All right. Welcome back, my fellow profit seekers and capitalists. I am your growth stock guru, Rick Action Jackson, and it's Wednesday, August 5th. Thanks for joining us. On Wednesdays, I let people text or email in stocks they'd like to hear me comment on. I'll walk you through whether or not it would be a buy or a sell under my top quintile discipline. And then I'll also add in a few comments on, all right, it may not qualify for my strategy, but is this a good stock and a good company or not? Again, this show is for entertainment and education purposes only. I am not a licensed financial advisor. This is not financial advice. If you find any of these stock ideas of interest, please review them with your financial advisor before you invest any money, especially if you're a beginner at investing. Stock market is a dangerous place. You can lose money. So onward and upward, we're going to kick off here with a company called Fiserv, ticker FISV. And Nick in Stanford would like to know, is this a buy, sell, or hold? Let's go to the chart. Fiserv is a company I've watched for a long time because I'm a sucker for a cheap stock in an industry that grows double digits. Fiserv peaked out back in, I think it was February of 25. Let's go to the 5-year chart. Yeah, there it is. They were a darling of Wall Street because they just kept beating the numbers every quarter, and that's a trait I look for. But then they missed one, and they've missed 2 of the last 5. So you can guess which ones they missed. They missed this one, and they missed this one. And they pre-announced on lowering guidance here. So the CEO recently resigned. They're in search of a new CEO. And the stock has finally found some footing. What this stock's got going for it is it's very inexpensive. It's selling at about 5 times earnings. That's a joke. I mean, utilities sell for more than that. Con Edison, which has no growth at all, sells for more than that. They are in management disarray, but they do make a fair amount of money, and they own Clover, as well as about a half dozen other credit card processing businesses, and they do a few other things in the financial technology world where they get paid per transaction, but credit cards aren't involved. Because they've missed 2 of their last 5 earnings, I'm going to pass on this, Nick, as far as the top quintile strategy. You have to beat the earnings 2 of the last 3 quarters, which this company has done. But the guidance right now is super low because there's no CEO. So the CFO is just basically predicting numbers that are a little bit above the year before. So I don't think you deserve a medal for growing 5%. But this is a great takeout target. If they bring in a new CEO that's got credibility in this industry, this stock could really get moving if he gets any results. But the other 2 reasons why I wouldn't give a stock like this a chance is that there's a lot of competition in the credit card processing world, and the industry is not growing like it used to. We're now doing more credit card transactions than cash. When Americans are paying for more stuff with cash than credit cards, the growth in this industry was huge. Every year, a greater percentage of GDP got transacted on credit cards. That's a lot tougher to do. It's a lot tougher to grow double digits now because most of our economy is now done electronically. Also, I'm not convinced that between artificial intelligence and blockchain, that somebody's not going to come out with some super duper new transaction processing platform and blow away all the older models. And one person working on that is Elon Musk. Elon Musk is working on a satellite phone, and part of the phone is going to be an electronic wallet. And he's the man that created PayPal. So I don't want to go against Elon Musk. I don't want to wait for some new technology to show up that's going to blow me away. I know Visa and MasterCard spend a lot of money on those technologies trying to invent the new standard themselves so they can position themselves properly, but this company doesn't. I think this company's just waiting to be taken out. It may be taken out, it may not, but that's not enough for me to buy it. So we're going to pass on Fiserv. Moving, and if you own it, I don't think you have to sell it now. But the reason to hold it is that somebody might buy them. I don't think the reason to hold it is the company's going to be a success in the future, unless they pick a superstar CEO and the CEO's got a way to grow this company that most people haven't thought of yet, which is possible. And look what the new CEO did with American Express. Okay, so next one is TENB, TENB. And let's go to the chart. Tenable Holdings is a cloud, it's a cybersecurity and cloud storage company. I jumped on this 6 months ago. Here's the 5-year chart. This stock didn't do much for a while, and then it collapsed because it missed 1 or 2 earnings reports. Got a new CEO here, and I bought a lot of it down here myself between $17 and $19. I've got a little bit left, and I have a sell order in to sell what I have left at 38 because I don't think the stock's going to make a new high. I think it's going to run out of gas here trying to make a new high. But it's a very interesting company, and you can make the argument it's worth holding higher than that. I have a tough time making the argument that you should buy it here. This company has traditionally grown 10 to 15% a year. They had a couple of quarters where the growth was 20 to 25, but that's because they're getting the tailwind of all these data center build-outs. And the one thing that makes TENB different than the other data center companies is that they have top-level national security clearance, and half their customers are the Pentagon or the CIA or high-level defense industry data. And not many companies qualify for that. It's a very short list. And most of their facilities is in the Washington, D.C. area. Their headquarters is in Columbia, Maryland. And there was a big spike in government spending on this data storage stuff between, the war in Russia and the war in Iran. But I don't think we're going to see it continuing to spike. I think it's going to level off. So I'm inclined to take the money and run. They have a track record of reporting higher earnings than predicted, which is what we look for. They haven't missed any. They're batting 4 for 4. They're actually batting about 11 or 12 for 12. If they beat the numbers next quarter, and they are reporting soon, it's either tomorrow or next week, I could see the stock going to 55 in 2 years. So if you picked it up under 36, that would be a 50% return, which is what I look for to buy a company. But I think there's too many reasons why their growth is going to slow down. I mean, you don't see government demand pick up 25% unless you're on some kind of new product curve. And I doubt they're going to be able to maintain their momentum. It was fun while it lasts, but I'm moving on from 10B. I can't tell you I've gotten a technical sell signal here, except when it spiked up to $40, the chart was overextended, and it only had 20% left of upside. And if I think you only have 20% left of upside over the next 18 months, and you've already made over 100%, I'll take the money and run whenever that happens, unless it's one of the country's 10 best companies. So already played this one myself, already sold it. I'm going to tell you, Bill in Fairfield, move on. Not a bad company, just not a good time to buy it. Okay, next we have SHAK. Shake Shack, person that asked for this is Jeff in Long Beach. Shake Shack had some very interesting news today. The Starboard hedge fund announced that they're now the largest shareholder. They've bought a lot of this stock in the last 60 days. And they have a superstar there by the name of Jeff Sauer, who he was part of the team that turned around Darden restaurants. He turned around the Olive Garden. He turned around Papa John's after the founder was accused of all kinds of racist comments and got kicked out. And he wants to take on Shake Shack. Shake Shack had a great run when it was a younger company. Here you see the 5-year chart. You could have picked this stock up for under $50 in 2022, and by 2024, it's over 120. They had a couple of quarters where they only just made the numbers. They didn't beat them, and then they missed the first quarter of 2025. They missed it by a lot. And the excuses they gave was they didn't do a good job of managing the higher prices for beef and for rolls. Okay, that's a pretty basic restaurant skill. You should be adjusting your prices if your costs go up. Wall Street lost a lot of confidence. But these people coming in, they're not the type of people where they're going to break the company up because the assets are worth more than the stock price. They're the type of people that come in and work with management to improve the procedures and operations that the restaurant uses to improve profitability and product quality. So I think these guys are the right people at the right time to turn this company around. I mean, the food at Shake Shack is pretty good. Their service could be a little better. Their cost control could be a little better. They've got excellent locations. They've always been willing to pay up for the right location. And, their products are premium products. So apparently the formula has worked in the past. I think Starboard's going to get it to work again in the future. My target 2 years out for Shake Shack's $113. We get there by using a 45 multiple on $3 of earnings. And my 4 years, 155, using a 35 multiple on 525 in earnings. And I think those earnings numbers could be low. If Starboard improves the margins on this business, which is what they're known for doing, they're known for improving restaurant margins, stock could do a lot better. So I'm going to tell you, Jeff, to buy here if you want. I'm not going to buy it myself personally because there's a lot of ifs here, and the upside's only 50%, or at least I can only see 50%. They might dramatically improve the profitability, and then I'm going to regret missing the boat. But with this new management move, I think the odds here are good that this stock will go higher. And if they get back in the habit of beating the numbers, which they used to do, this stock could be a significantly bigger winner than the targets I gave you. Who knows? I might jump on it after another quarter of good earnings at a higher price. But today, I'm going to wait. But I won't talk you out of it. If you want to buy this, it's a good quality company. It's got a good balance sheet. And they've got a lot of parts of this country and Canada and the world that they haven't penetrated yet. You always want to be certain you're not getting into a restaurant chain too late. Once there's a lot of them, it's very tough to make a lot of money on the stock. You can make a decent return, and McDonald's pretty much routinely doubles your money every 6 to 8 years. But that's not what I'm looking for. I'm looking for stocks that can double your money in 4 years. But Shake Shack's young enough where I think it could do that. So that's Shake Shack, S-H-A-K. Next one is UiPath. UiPath is very controversial in the institutional world. Charlie in White Plains asked me for this. Let's go to the chart. This stock has had no pulse at all for almost 3 years. But they keep beating the expectations, and they keep growing nicely. They just went profitable, so now the tough part starts. They've been consistently reporting very good revenue growth in 15 to 25% range, but not making money. What does this company do? This company is not exactly like Palantir, but it's kind of like a baby Palantir. They tend to focus on companies that Palantir won't go near. Palantir focuses on the 3,000 to 4,000 largest organizations in the world. These guys tend to focus on companies of 500 to 2,000 people. They have a dozen large companies as clients. Now, just like Palantir, when they come in and they put a software platform in to get all your different AI programs and all your different software programs working better, talking together, improving security, there's a lot of customization involved. They seem to have no problem charging the small companies for the customization, but they're being accused that the reason why they win the big accounts is that they don't charge the big accounts for customization, but then the account generates a lot of revenue, but not any profit. Now the pressure's on for these guys to show profit. I'm going to give them the benefit of the doubt. McKinsey came out with a study that showed 97% of the companies out there that tried to implement AI to improve productivity failed if they didn't have a third party like Palantir or UiPath or McKinsey or IBM handling the transition. Let's face it, nobody knew what AI was a year ago. So if you don't have a specialist involved helping you, it's tough to utilize all of its possibilities. The pie that this company sells you gets bigger every year. The slices get bigger. Palantir is too big and too busy to focus on these smaller companies. And I think now that the company's making money, they're going to have more discipline on their pricing. And I think if their next quarter beats expectations and they're profitable, last quarter they were profitable and that wasn't expected. Now the pressure's on to stay profitable. If they beat the earnings report next time, I think the stock could fly up into the 20s very quickly. And you see this big base you got here where the stock hasn't done anything for 3 years? Alan Shaw always taught us in technical analysis, the longer the base, the bigger the upside. So in the old days, I'd take a compass and extend the compass the length of the base and then turn the compass up. And if I do that on this, I get a target of over $60. So there's great upside potential to downside risk here, which is why I'm going to tell you to buy it. And I think this was on one of my recommended buys about a month ago at 12. It's at 13 3/4. They're reporting their earnings shortly. I think it's either tomorrow or next week. And if you like UiPath, Charlotte and White Plains, I'm not going to talk you out of it. And in fact, I might even buy some myself when the show is over. Lastly, we have AMD. Oh, my target on UiPath 2 years out is $22, and 4 years out is $34. So if you can get it under 14, that's a good risk-reward ratio. Finally, we have AMD. AMD reported their earnings last night. They were fantastic. Yet the stock's down $30. Mark in Princeton, New Jersey is asking, should he sell what he's got? Should he hold or should he buy more? I'm biased on AMD. It's been one of the best stocks to own since March. Since March, it was up over 150%. And on a 5-year basis, it's up about 500% in 3 years. But the reason why I've always been biased against it is they're very competitive. They're very capable. But in every market they've been in, whether it was SRAM or whether it was CPUs or today GPUs, they're the number 2 player in the market, not number 1. The number 1 player typically has more revenue, more market share, and better margins, which means better returns on your capital. So I've never made money with AMD, although a lot of people have. But when I look at the results and how the stock did today, they had killer results. They beat every number everybody expected. So why is it down $30? Well, it's selling at about 40 times earnings. NVIDIA's at 22. NVIDIA's got 90% market share in the GPU market, and they're twice as profitable. Intel has 60% of the market in CPUs, and AMD's stock on a market cap basis is more expensive, but Intel's a bigger company, and Intel manufactures their own product. AMD has to count on firms in Thailand to make their chips for them. And trust me, when Taiwan Semiconductor gets a phone call from Jason Wong at NVIDIA saying, I need more inventory ASAP, they're going to take care of him ahead of AMD because they're buying 800% more product from them. So people have made money in this stock, and this company has done everything it should to qualify under my top quintile strategy, except price. I can't justify a 40 multiple for this company. Not when NVIDIA is selling at 20. It should be the other way around. So I would say sell AMD and buy NVIDIA, or don't buy AMD, buy NVIDIA. This company's done nothing wrong. It's just mispriced, and I don't believe you pay more for number 2. You pay more for number 1. All right, that's all we got this week, folks. Thanks for tuning in. See you down the road, and may all your trades make money.